US dollar under siege. Danish pension fund leads Treasury. Exodus. Ingoldsby script. The largest pension fund in Denmark just fired the first shot in what could become the complete collapse of US Treasury demand. ATP, managing $180 billion in retirement savings, announced they're liquidating their entire US government bond portfolio. Not reducing it, not rebalancing it, liquidating it completely, and they're not alone. This isn't portfolio rebalancing or risk management. This is coordinated abandonment of the US debt system by the world's most conservative institutional investors. When pension funds that have held treasuries for decades suddenly declare American government debt unsuitable for long-term obligations, something fundamental has broken in the global financial architecture. What I'm about to reveal will change how you understand the stability of the US dollar, the sustainability of American government debt, and the coming crisis that most Americans have no idea is approaching. I am a private financial analyst with 15 years of experience tracking sovereign debt markets and institutional capital flows. I built this channel because mainstream financial media won't report what's really happening when foreign institutions quietly abandon US assets. They can't afford to tell this story because it exposes the mathematical impossibility of infinite debt expansion without real consequences. The Danish announcement came at exactly 9:30 a.m. Copenhagen time on January 18th. ATP, Arbejdsmarkedets Denmark's largest pension fund with $180 billion in assets under management, released a statement that should have sent shockwaves through Treasury markets. Following comprehensive analysis of long-term fiscal sustainability and currency risk factors, ATP has determined that U.S. Treasury securities no longer meet our fiduciary requirements for retirement security. We are implementing immediate liquidation of all U.S. government debt positions. Immediate liquidation. All positions. The pension fund responsible for retirement security for 5.2 million Danes just declared that American government debt is too risky to hold. But here's what makes this truly terrifying. ATP didn't make this decision in isolation. Intelligence from Nordic financial networks suggests coordinated action across Scandinavian institutional investors. Norway's government pension fund. Global, the world's largest sovereign wealth fund with $1.4 trillion in assets, has quietly reduced U.S. Treasury holdings by 34% over the past 6 months. Sweden's AP funds have implemented de-dollarization protocols across their $200 billion in combined assets. Finland's state pension funds have established currency diversification mandates that effectively exclude new U.S. debt purchases. This isn't coincidence. This is coordinated flight from U.S. dollar assets by the most sophisticated money managers in Europe. Institutions that manage the retirement security of entire nations are abandoning American debt simultaneously. Let me show you why this represents an existential threat to U.S. financial stability and what it means for anyone holding dollars, dollar-denominated assets, or faith in American fiscal responsibility. The mathematics of dependency. To understand why the Danish exodus matters, you need to understand how dependent the U.S. government has become on foreign treasury buyers. The numbers are staggering and getting worse every quarter. Current U.S. national debt, $34.2 trillion, and rising at approximately $1 trillion every 100 days. Interest payments alone now exceed $1.1 trillion annually, more than the entire defense budget. But here's the critical detail most people miss. The U.S. government doesn't just need to service existing debt. They need to constantly issue new debt to refinance maturing bonds, fund budget deficits, and maintain the liquidity that keeps Treasury markets functioning. Total Treasury issuance requirements for 2026, approximately $8.7 trillion. That's not net new debt. That's the total amount of bonds the Treasury Department must sell to keep the government operating and meet existing obligations. Domestic buyers, American banks, insurance companies, mutual funds, individual investors, typically absorb about 65 or 70% of Treasury issuance. The remaining 35% must come from foreign buyers, sovereign wealth funds, central banks, pension funds like ATP. That foreign component represents roughly $3.0 trillion in annual Treasury demand that must come from institutions like the ones that are now fleeing U.S. debt markets. When ATP liquidates $12 billion in Treasury holdings, it's not just the immediate selling pressure that matters. It's the signal sent to other institutional investors that one of Europe's most conservative money managers has concluded that U.S. debt is unsuitable for long-term holdings. The domino effect accelerates. Within 48 hours of ATP's announcement, 3 more European pension funds issued similar statements. Netherlands' ABP, Switzerland's Publica, and Austria's VBV collectively manage over $400 billion in retirement assets. All announced strategic reallocation away from U.S. government securities. But the most disturbing development is not the selling, It's the buying patterns that have emerged to replace these foreign Treasury holders. Federal Reserve purchases of U.S. Treasuries have increased by 340% over the past 6 months. Not quantitative easing programs announced to the public. Quiet, technical operations buried in weekly balance sheet updates that most analysts ignore. The Fed is becoming the buyer of last resort for U.S. government debt. They're monetizing American fiscal deficits not as official policy, but as emergency liquidity provision to prevent Treasury auction failures. Translation: the U.S. government is printing money to buy its own debt because foreign institutional investors have stopped showing up to Treasury auctions. This creates an inflationary feedback loop that explains why consumer prices continue rising despite official claims about inflation being under control. The government prints money to buy its own bonds. Those newly printed dollars enter the economy through government spending, and prices rise accordingly. Meanwhile, the institutions that are selling treasuries are not putting that capital into other bonds or traditional safe haven assets. They're converting dollars into physical assets, alternative currencies, and non-dollar investment vehicles. ATP's reallocation strategy provides the template: 40% into European real estate, 25% into precious metals and commodities, 20% into non-dollar sovereign debt, 10% into cryptocurrency and digital assets, and 5% into cash reserves in euros and Swiss francs. Notice what's missing from that allocation. Zero exposure to US dollar-denominated assets. Zero faith in American monetary stability. The currency war implications. What makes the Nordic exodus particularly significant is the institutions involved. These aren't speculative hedge funds or momentum traders making tactical bets against the dollar. These are the most conservative money managers in the world, responsible for retirement security of entire populations. Their mandate is capital preservation over decades. They don't make dramatic allocation changes unless they believe fundamental conditions have shifted permanently. ATP's risk management team ran scenarios extending to 2050. Their models showed U.S. debt-to-GDP ratios reaching levels that historically trigger currency crises, hyperinflation, or sovereign defaults. Their conclusion: holding U.S. Treasuries for 25-year pension obligations represents unacceptable risk to Danish retirees. But the implications extend beyond pension fund risk management. Nordic countries are effectively declaring monetary independence from the U.S. dollar system. They're positioning their economies to function regardless of American fiscal stability. This creates precedent for other regions. If Scandinavian institutions can successfully de-dollarize their reserve assets, why can't Asian pension funds? Why can't Middle Eastern sovereign wealth funds? Why can't Latin American central banks? The dollar's reserve currency status depends on international confidence that American debt is the safest store of value available. When that confidence erodes among conservative institutional investors, reserve currency status becomes vulnerable to displacement by alternatives that offer superior long-term stability. The Federal Reserve's impossible position. The Fed faces an impossible dilemma created by foreign Treasury liquidation. They can either allow Treasury yields to spike, which would crash bond markets and trigger recession, or they can step in as buyer of last resort, which accelerates inflation and undermines dollar credibility. Current 10-year Treasury yields around 4.2%, already reflect stress in bond markets as foreign demand evaporates. Without Fed intervention, yields could spike towards 6 to 8% levels that would make government debt service impossible and trigger systematic financial crisis. But Fed intervention through Treasury purchases essentially admits that the U.S. government cannot finance itself through normal market mechanisms. It confirms that American fiscal policy requires money printing rather than genuine investor demand. This confirmation accelerates the very foreign capital flight that created the problem initially. International investors recognize that Fed Treasury purchases represent monetization of government deficits, the classic precursor to currency collapse. The Fed is trapped between two forms of financial system failure: immediate bond market collapse or gradual dollar system destruction through inflation and foreign abandonment. Early indicators suggest they've chosen gradual dollar destruction as the less immediately catastrophic option. The acceleration timeline: based on current foreign liquidation rates and Treasury issuance requirements, the timeline for dollar system stress is accelerating faster than most analysts recognize. Monthly foreign Treasury liquidation now exceeds $85 billion. At this pace, foreign official holdings of U.S. government debt will decline by over $1 trillion annually. That's $1 trillion in Treasury demand that must be replaced by domestic buyers or Federal Reserve monetization. Domestic absorption capacity has limits. American financial institutions already hold Treasury concentrations that stress their capital ratios and risk management frameworks. Individual investors face portfolio allocation constraints and inflation pressures that reduce their Treasury demand. The Fed becomes the primary marginal buyer of U.S. government debt within 12 to 18 months unless foreign liquidation trends reverse dramatically. But foreign liquidation is accelerating, not reversing, as more institutional investors follow ATP's template for de-dollarization. The mathematical endpoint is clear. The U.S. government finances itself entirely through money printing within 2 years, or Treasury yields spike to levels that trigger immediate fiscal crisis. My personal assessment: I'm being completely transparent about how I'm positioning for this crisis. The Nordic pension fund exodus represents the beginning of dollar system breakdown, not just market volatility or portfolio reallocation. I've reduced dollar-denominated assets to minimal levels required for operational liquidity. The majority of my wealth is now held in physical assets, foreign currencies, and investments that maintain value independently of U.S. dollar strength. This isn't anti-American positioning, it's mathematics. When the world's most conservative institutional investors conclude that American debt is unsuitable for long-term holdings, individual investors should pay attention to their analysis rather than hoping for different outcomes. I'm watching several key indicators that will signal acceleration of dollar system breakdown. Treasury auction bid-to-cover ratios below 2.0 indicate insufficient demand at current yield levels. Foreign participation rates below 15% in major Treasury auctions signal continued institutional abandonment. Federal Reserve Treasury holdings increasing by more than $100 billion monthly confirms monetization acceleration. If these indicators align within the next 3 to 6 months, dollar system crisis transitions from eventual probability to immediate reality. The end game approaches. The Danish pension fund exodus isn't an isolated event. It's the visible beginning of coordinated foreign abandonment of the U.S. debt system by institutions responsible for managing multi-generational wealth preservation. When entities with 25-50-year investment horizons conclude that American fiscal sustainability is questionable, they're making judgments about political and economic trends that extend far beyond current market conditions. Their message is clear. The U.S. government has issued more debt than it can service without destroying the currency used to denominate that debt. The mathematics of $34 trillion in debt growing at $1 trillion every 100 days simply don't work without consequences that make dollar-denominated assets unsuitable for conservative portfolios. The Federal Reserve can delay the crisis through Treasury monetization, but monetization accelerates the underlying problem by undermining international confidence in dollar stability. We're approaching the point where foreign institutions complete their exodus from U.S. assets, domestic absorption capacity reaches limits, and the Fed becomes the sole buyer of Treasury debt issued to finance American government operations. That's not monetary policy, that's currency destruction with a technical name. The world's most conservative money managers are already positioning for post-dollar monetary systems. The only question is whether individual investors will recognize the transition before or after their dollar-denominated wealth evaporates through inflation or currency collapse. The Danish pension fund fired the first shot. The Treasury exodus has begun. Position accordingly.